Welcome back, everybody. I'm Jeff Barton for the Mortgage Minute here for the Mortgage Voice. We're on each and every day on LinkedIn and Facebook, as well as Instagram and Twitter. Maybe not as much as Facebook and LinkedIn, but yeah, we're here. We're all over the internet as well as being on YouTube. Go to Jeff Barton, the Mortgage Voice, to see the Mortgage Minute, as well as our radio show called The Mortgage Voice. We've been doing that for about 6 or 7 years now, hundreds of shows on there, and we give you a daily briefing and update as to what's happening in the mortgage and real estate world. Let's get right to it. The rates today at 2.99 for the 30-year fixed. The 15 is at 2.55. FHA is at 2.43. The jumbo loans are at 3.37, and the 5/1 ARM is at 2.75. All of these are up, and they're up because the stock market had a terrible week, which meant most of the money that had to be placed somewhere were placed in treasuries, and thus driving the price up. And if the price goes up in treasuries, you're going to see that the mortgage rates are going to go up too. It's a symbiotic relationship. That's why we look to treasuries to be able to really scope out and evaluate what's going to happen in the mortgage rate market. Another thing that's happening is the standard index, which we've used for a decade plus, the LIBOR, the London Interbank, is being we're changing that, and it's going to be more of a Fed funds rate. And how is that going to affect the mortgage rates? How is it going to affect availability of funds and the stability of rates is yet to be seen. We're going to talk some more about that when I get more information on it. But I just wanted to give you a heads up as to actually that's what's happening. So stock market down, flight to treasuries, price goes up, therefore rates go up. That's how it works. Okay. Time in refinance. One of the things in the refinance market that has really hurt a client of ours at Malibu Funding, the sponsor of the show, the slowdown time in underwriting and in turnaround for conditions. Conditions are what the underwriter places on a file once it has gotten through the initial underwriting process and the approval process. So if it normally is a day for conditions or 3 days in underwriting for approval, you could triple all that for most lenders. And that's a problem, especially on a 30-day contract of purchase, or you just need to get it done. We had one that, and this doesn't happen all the time, but one that did hang around for about 60 days. Client was mad, blamed the loan officer, canceled the deal. It's a problem. So expectations are to get that done in 30 days? Make sure you ask your loan officer, make sure you ask your lender exactly what the turn times are for conditions, how long a file is going to be in underwriting before approval, and what is the ETA for closing of the file. Very important for you if you're in purchase, certainly, and if you need the money looking for a cash out refi, that's probably important too. Let's see, new loan limits. Yes, they're on the way. Every year about this time, we have the counties and they average out what their real estate prices are, and we get conforming loan limits. Now, I don't know if you know what that is, but a conforming loan limit is exactly what Fannie and Freddie will buy up to a certain number. In Los Angeles County, I think it's 725. In Albuquerque, it's probably around 471. In Las Vegas, Nevada, it's probably 351. So you have to ask around. Each county has their own particular conforming loan limits, but those are coming now soon. And if they are conforming limits that are higher, that means that FHA will also conform to those loan limits, and your FHA loan may be able to be gotten for a little bit more money. That's pretty important for some people who are borrowing right at the margin to where they need to be. And if they could get a few extra bucks in the loan, it'd be a good idea. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for tuning in. You can see us next time.